International Competition and Company Value. Professor Jan Bosick. Economic players. Diversity of economic players. Entrepreneurs. Classic private company. Capital corporation, limited in stock. Owners, investors and managers. Employers and employees. Cooperatives. Communal companies. Transnational corporations, TNC, and foreign direct investment, FDI. Capital groups. State and public companies. International organizations, regional, local authorities. Entrepreneurs and firm. Organization of business activity. Legal forms of running business. Ownership. Types. Management types. Administration, entrepreneurship, strategy and value-based management, VBM. Corporations and governance. Core competences and competitive advantage. Strategy and company business environment. Investors and entrepreneurship. Owners, investors, shareholders and stakeholders. Financial investors and passive supervision. Strategic investors, competence and entrepreneurship. Entrepreneurs, market innovators. Entrepreneurship, search for value, risk and competition. Company law. Company form and entrepreneurship. Sole proprietorship. Partnership. Limited partnership. Limited liability partnership. Unlimited company. Limited company. Corporation, stock company. Public company. Cooperative. The firm in its institutional environment. Doing business report by the World Bank. 1. Easy off doing business. 2. Starting a business. 3. Dealing with licenses. 4. Employing workers. 5. Registering property. 6. Getting credit. 7. Protecting investors. 8. Paying taxes. 9. Trading across borders. 10. Enforcing contracts. 11. Closing a business. Strategic questions for running an international competitive business. Who? With whom? Why? What? How? Which resources? For whom? What? Supply follows market demand. Innovation ignites demand and changes preferences. Excess of demand over supply provides an opportunity for a supplier to reach higher profits. Increased demand and prices encourage, ceteris paribus, producers and suppliers to increase supply. Higher profitability affects the allocation of resources. The idea is to put more resources in profitable activities and assign less resources to less profitable ones. Who and with whom? Company and our business partners. Companion our sub-suppliers. Local and international. Going global and value creation chain. International value creation chain from idea, research, production, marketing and distribution. International value creation chain and distribution of benefits and risks. Why search for value? Motivations for human economic activities, search for value. Opportunities, choice and competition. Benefits, pecuniary and non-pecuniary. Rents, wages. Dividend, profit, interest. Power, authority. Prestige. Other. Competitive game winners premium. How? How to reach benefit in a competitive market environment? How to win competition? Entrepreneurship and management. Opportunities and inventions. New products and technology. Market arbitrage. Profit maximization by least cost production, holding quantity and quality constant. Scaling of activity. Specialization. Reduction of unit costs and risk. Integration and outsourcing. Groups, world nets and single business units, SPU. New products, quality and innovation. For whom? Buyers' preferences and effective demand. Market allocates, both output and input resources, factors. Distribution of income, wages, interest, rent, and profit is determined by market. Individuals who are more highly valued resources receive higher incomes. The allocation of goods and services is determined in the output market. Factor markets allocate resources. corporate governance and international competition, ownership and management, shareholders and stakeholders, principal agent problem, company law, company status, company objective and strategy, general shareholders meeting, supervisory council, management, continental corporate governance, Anglo-Saxon corporate governance, other, new paradigm, human capital and entrepreneurship, human capital, learning, competences, entrepreneurship, venture capital, strategic investors, core competence, protection of technology and know-how, strategy and value-based management, VBM, search for value related to new opportunities and challenges, strategy focused on new investments, products, processes, know-how, distribution and innovation. Strategy must be an ex-ante planning in a challenge environment. Future-oriented management. Strategy is a concept of an entrepreneur to make a profit. It is not administration, it's a concept to make profit. Where do we create value? Key drivers of shareholder value? Net cash flow, NCF, weighted average cost of capital, WACC, risk and debt. Is our strategy linked to shareholder value creation? What is the source of our competitive advantage? What is our core competence? What is our creative, innovative idea for value creation? How does our return compares to competitors? Financial value drivers. Revenue growth, net cash flow, profit margins, capital expenditure changes, working capital changes, competitive advantage period, weighted average cost of capital, cost of equity, debt, capital structure and company risk. Competitiveness and value-based management, VBM. Competitiveness, business objectives and shareholder value. How do we get our managers to act like owners? Corporate governance in company organization and management. How do we link business unit performance with corporate team objectives? How do we link rewards to improved shareholder value? Being competitive means to take business decisions increasing total cash flow, reducing cost of capital, and reducing company risk. Total cash flow equal net outflows. Total cash flow equal net operating plus financial and investment flows. A competitive company creates value while an uncompetitive company destroys it. Competitiveness is an ability of an organization to create value. Competitiveness is to a large extent a matter of efficient management. Competitive potential is dependent on creative ideas and efficient management. Competitiveness and cash flow. Strong correlation between total free cash flow and share prices. Shareholder value equal present value of future free cash flows discounted at the weighted average cost of capital of the company, less the value of debt. Total free cash flows equal net operating profit plus changes in capital plus changes in debt. Who is market winner in international business? A competitive company is a market winner. It is a company which wins a game to attract a customer and an investor. A competitive company must provide value to customers and investors alike. A competitive company provides an attractive market alternative for a customer. A competitive company is an attractive investment opportunity. A competitive company is also attractive for stakeholders. Competitiveness, investment attractiveness, and shareholder value. Shareholder value is a capital market perspective on competitiveness of company. To build a shareholder value, you must deliver performance in operating, financial and investment better than your main competitors. To outperform competition, you must develop strategies and policies that will deliver cash flows better than expected by capital market. Corporate objectives and business unit performance measures. Customer satisfaction, operational performance, employee skills and satisfaction, quality of organization learning and openness, new products, quality, innovations. Identifying competencies value chain analysis, supply side, cost efficiency, value added, quality, innovation. Competitiveness and stages of development. cost.diversity.quality.innovation.china.spain.france.usa.income per capita.level of development.